Good afternoon, everyone, and welcome to our webinar on Global Equity Outlook. We have with us Mr. Peter Garnry, who will be our speaker for the event. Mr. Garnry will be sharing his views on the evolving trends and challenges world over to help investors get a wholesome perspective of the changing investing environment and the opportunities that lie ahead. Before we proceed, I'd like to share a brief profile of Mr. Peter Garnry. Mr. Garnry is the head of equity strategy at SAXO Group and has been associated with the group since 2010. A key part of his role involves developing strategies and analysis of equity markets for both individual company stocks and the markets in general through application of statistics and models. Mr. Gandry also contributes to the Saxo quarterly outlook and annual predictions and is also a regular commentator on prominent TV channels including CNBC and Bloomberg TV. Without further ado, I would now request Mr. Gandry to take over and begin with his presentation. Over to you, Peter.
Thank you so much, and what a pleasure to speak to you all. I know it's afternoon in India, and I'll do a 45 minutes presentation, and then we'll do a Q&A. And the title for my presentation, which is an equity outlook, is whether the tide is turning. And I think it's a very good picture on what potential is to come in 2022. Because a lot of things is going on in the world, and let's just start right with the high level. So we have an equity market, which today this is the U.S. equity market. You can see on the chart to the left, which is a model that shows how U.S. equities are valued. So you can see in an absolute sense, U.S. equities are quite highly valued relative to even the .com period. So you could say that the valuations are quite stretched in the US. They are high in a historical sense, and the chart to the right shows you what we probably can expect in terms of real rate returns going forward as these current levels. As you can see, they're quite low. So I think this is the starting point for every investor, that we've gone through a period, multiple years, with expanding equity markets in terms of earnings and sales growth. Technology companies are much bigger than they were just 8 years ago. Valuations are also high, and the equity returns we have enjoyed over the past 10 years have been extraordinarily high, and our expectations for the near-term future should be lower because of these higher valuations. But we cannot just judge equities in isolation, because you have a global financial market, and with the two largest asset classes being equities on the one side and bonds on the other side, these two are constantly in a form of equilibrium. And one of the best finance professors I know of is Athwas Damodaran from the New York University, and he has some very long-term perspective on what's called the equity risk premium. So how much you can expect equities to deliver in returns above bonds, the risk-free return. And in the US, you can see here that despite the high absolute equity valuations, the equity risk premium is still around 4.5% for US equities. So if you take the current 10-year yield in the US, which is around 1.6%, and you add the equity risk premium, you get very close to around 6% in nominal returns. And if we get inflation rate somewhere between 2 and 3% over the next 10 years, you will have a pretty decent real rate return. Whereas if you invest in bonds today at a very low yield, I'm quite sure that the real rate return will be negative for these bonds. So equities are expensive in absolute terms, but in relative terms, it is not that bad. One of the things that we need to be aware of as an investor, and that's one of the things I'll be talking about later as well, is something called equity duration. So equity duration is basically a concept that is about how sensitive equities are to changes in interest rates. And we have very low US real yields today. So the red circle in the upper left-hand corner of this chart here on slide 4 shows you the current equity valuations on PE, the y-axis, but then on the x-axis, you can see the US real yield. So that is the yield you're offered in the market minus inflation expectations. And as you can see here, we have the same valuations, at least on PE, as we had in .com, but we have a much lower US real yield. And that means that our equity duration has gone up significantly. We are much more sensitive to a change in the interest rate, which is very important, because we are beginning to see, and you also see that in India, we're beginning to see inflationary pressures building in the global economy to an extent we haven't seen for many decades. We'll be talking more about that, because if we get a rise in the interest rate, that will have an impact on equities for next year. One of the things that we are observing is that we've seen part of the inflationary stories are manifold, but one of the things are, input costs are impacting profit margins. So what we have seen in this Q3 earnings season, you can see that with the MSCI World, the Nasdaq 100 and S&P 500, is that we're beginning to see profit margins rolling over. And what that means is that will begin to act as a headwind on earnings growth for these companies. So when your profit margin is coming down, the only way to keep up the same earnings growth momentum is to actually see your sales growth accelerating. I don't think the sales growth will accelerate going into next year. So what we'll probably see is we'll begin to see these headwinds acting as a drag on earnings growth. At the same time, as you can see here, courtesy of Goldman Sachs, we have wage pressures in the US. We have the highest wage pressures in the UK in 24 years. It's also a phenomenon we see elsewhere in Europe and in Asia in some countries. So basically all input costs are increasing. So we have an all-time high in commodity prices, which will continue to go on because of urbanization in Asia, Africa, and South America. We also have the green transformation. Transportation costs are high across the globe. We have congestions and bottlenecks everywhere. One of the reasons is that we have extraordinary high goods demand in the Western world, and we have China that is pursuing a zero COVID case policy, which is very difficult if you want to operate a lean and flexible economy. We have rates growth, as I said. We have galloping housing prices basically in every country in the world, and we know that rent prices and house prices have to be in an equilibrium. Otherwise, there will be a net economic benefit from switching either from owning a house to be renting your house, vice versa. So these two markets have to be in an equilibrium. So what you typically see historically is that when you have house prices rising a lot, rent prices tends to follow afterwards, and that's a pretty big part of the CPI component in many CPI baskets around the world, inflation baskets, I should say. And then interest rates, we think will go higher as we move into 2022. We have a U.S. central bank which will have a lot of changes to their board members around New Year, and the new board members that are coming into the Fed are more hawkish. They're leaning towards the Fed should increase or accelerate their tapering of bond purchases, but also begin hiking interest rates. We're also already seeing central banks around the world hiking interest rates somewhat, and the central bank in England is also considering increasing its interest rates. And as you can see here, the long-term average price in US 10-year yield is just around 2%, and we are currently just around 1.55 or 1.6%. We expect a regression to the mean, and then we expect the interest rates to move firmly above the mean, closer to around 2.5%. So as you can see, all companies are facing this input cost. These are some charts showing these input costs. You can see the container shipping rates are just exploded over the past year. In Europe and the rest of the world, we have an energy crisis. That are the four small charts you can see there. Natural gas prices are accelerating. We just had a new all-time high in Asia LNG markets. We have electricity prices accelerating in the US. Coal prices are also ramping up across many different countries. And then the global supply chain disruption I talked to you about, you can see that in the lower hand left side of the slide. You can see the delivery time for semiconductors. So, and then you have Vitol's boss and Bolsa Trafigura, which are some of the two largest commodity trading firms in the world. They're both saying that the oil and gas market, because of underinvestment, I'll show you that in a few minutes, will stay in a state of situation where we'll have an upward pressure on oil and gas prices, because oil and gas will still be in demand over the coming years, but the underinvestment due to ESG and the green transformation will make prices continue to go higher. One of the things that are driving, there's a couple of things. One of the things that are driving the global economy to its current state of higher inflationary pressures is that the largest economy in the world, the US, is experimenting with extraordinary fiscal stimulus. So this chart here shows you on the x-axis the fiscal deficits to GDP in the US. We are currently at minus 11%. And then on the y-axis, you can see the nominal output gap in the US. And we have closed it So the Congressional Budget Office in the US over the weekend updated figures for Q3 this year, and the US economy is now estimated to be operating at full capacity. At the same time, we are doing heavy fiscal stimulus of the economy. And as you can see on the orange dot, we are in an environment we haven't seen for in more than 50 years. And this, coupled with extraordinary monetary policy expansion of the M2 money supply, as you can see here, we are running at right now at a 13% annual pace in the money supply in the US. So if you combine those two things, or all the things I've said, the rising input costs, function of very extraordinary fiscal and monetary stimulus into the economy, I think 2022 will be a year where inflation will surprise central banks, and central banks will try, hopefully not panicking, but a little bit in a desperation mode, trying to get ahead of the curve and change the narrative. Right now, the narrative among central banks is still that they believe in transitory inflation. We think that the transitory inflationary narrative is not the real narrative, but the real narrative is that inflation will be higher than expected. And it's because of that, we'll see central banks coming with higher interest rates to the market. To understand why we potentially are moving into a new super cycle on commodities and why we have the energy crisis around the world and we have commodity metal prices rising is this chart. So if you look at the blue, but also the orange, depending on what you want to look at, you can see that the investments in the global mining and energy sector are historically quite low. What is even more fascinating is that in 2001, China became a net importer of raw materials and commodities in general, instead of being a net exporter. And from 2001 until 2005, capex in the global mining and energy sector were quite low, and China was a huge demand driver in the global economy. And as a result of that, we had a 4-year period with commodity prices galloping higher, but a massive lag in the global mining and energy sector. And we think we could experience something similar this time around, that there will be, unfortunately, quite a big of lag for these companies to commit to investing to expand supply. And because of that, and because of the galloping demand from urbanization and the green transformation, we will see prices continuing higher in commodities. Several large banks, and we are in the same camp, are expecting a new super cycle in commodities. We have had 2 super cycles in commodities since the 1960s. So we had the one during the 70s where commodity spot prices went up by 20% annualized over around a decade. Then we had the second super cycle, which was, as I said, from 99 or 2000 until 2011, where we had a 16% annualized increase in spot commodity prices. And if we sort of extrapolate from the current lows during the pandemic, around a 19% annualized increase towards the end of 2030, you can see here that we need to see a rapidly expanding commodity spot market going forward. So taking all these things together, we probably are moving into a period with higher inflation. So the median inflation rate in the US since 1969 has been 3.1%. So these charts shows you what happens when you have an inflationary environment and when you don't have an inflationary environment. So when you have a inflationary environment with inflation rate below 3.1%, you generally have both nominal and real rate returns being quite attractive for US equities. That's the orange lines. If you take the blue lines, you clearly see that what happens when you have inflation coming into the equity market and the global economy, the nominal returns are okay for equities, but the real rate returns are quite disappointing. And that's the key risk for equities, I think, because we have these high valuations. The key risk is that if we get higher inflation, higher interest rates, that we could see a period where the equity rate, the equity returns in real terms get, not as good as they have been in the past 10 years. We also have to mention China as a growing risk in global equities. So we have the housing market, which is a cause for real concern because it's a very large part of the economic growth and their economy. Evergrande being one of the most prominent real estate developers have at the brink of bankruptcy. Right now, there's a lot of measures being conducted by the central bank in China, but also the government and the market industry itself to try to get through this housing crisis, but the pain is pretty real, and the growth rate is slowing down in China. So that's obviously a key risk for global equities, because China is the second largest economy and a growth driver of the economy. And then we have the technology sector. I've put in Tencent here. There is a lot of regulation in China, which is impacting some of the largest companies in the big indices and Chinese equities, and Tencent being one of them. China is pursuing self-reliance and common prosperity, and under those two policy initiatives, it is at this point quite uncertain what the long-term growth rates will be for technology companies, because we don't fully know yet how regulation will impact profit growth. Right now, U.S. technology stocks are trading at a premium to Chinese technology companies. As long as we're trading at a premium for U.S. equities, I think that tells you that there's something wrong with the Chinese growth story in their technology industry, because the underlying growth rates in Chinese technology companies are higher than the U.S. equities. So U.S. equities, in theory, shouldn't be trading at a higher risk premium, higher valuation premium, but they are right now. So my view is that investing in the Chinese equity market is a little bit risky at this point, and I'm not super keen on investing in the technology industries, because I'm still fearing that compared to the current expectations, that the Chinese technology companies will surprise and lower the longer term targets going forward. So I'm still a little bit hesitant. One of the things we also have seen in the Q3 earnings season is that U.S. companies are showing better improvement than countries outside the U.S. in terms of earnings growth, and there's a lot of it is driven by the Nasdaq 100. So the chart to the right here shows you the quarterly revenue per share in dollars for Nasdaq 100, S&P 500, and the MSCI World. And I think this chart shows you two things. So it shows you why we also have very few investments in the global mining and energy sector. So when you have such an extraordinary growth in digital companies, why would you invest in the physical world? But the lack of investments in the physical world is the causes behind commodity and energy markets right now making an inflationary impulse. But then also, the high growth rate in technology companies are also the reason why we think that investors should continue to be overweight technology companies. Simply, the business models are delivering a higher and more consistent growth rates than what you see in the old economy. And there's nothing yet in the numbers that are suggesting that is changing anytime soon. And we have one thing is that we have higher growth rates for technology companies. They also have a higher profit margins, as you can see here. The green line is the Nasdaq 100 U.S. technology stocks versus S&P 500. And you can see ever since the financial crisis, we have been in a new paradigm where the profit margins are more fat for technology companies than older companies, and they're growing faster. So that is the reason why we have seen these very strong equity markets, and in particular in technology. In 2021, we have launched at SAXO a lot of different theme baskets. So over the years, we have changed the way we look at equity markets away from doing a lot of single stocks analysis, and we have done a lot of quantitative work, looking at the traditional sectors and industries that everyone knows, industrials, financials, etc. And in 2021, we made the decision that we wanted to look at the equity market through a new lens. And we think that looking at different long-term trends and themes, and thereby theme baskets, is a much more rich way to look at the market. And the theme baskets you're seeing here in the table are the ones we have published this year. And you can see I've sorted it on year-to-date performance. So you can see the worst performing equity baskets right now are bubble stocks, payment companies, next-gen medicine, which is genomic companies and biotechnology companies, gaming, e-commerce, and then Chinese consumer technology companies. Those are the worst performing. And in the high end of the performance spaces, you have crypto and blockchain companies, Indian companies. In this case, we are looking at the GDRs, because this is SAXO have a global audience, and you can invest in India with ETFs, but if you want specific exposure, you have to look at the GDRs that are listed in the US or on the London Stock Exchange. of course, those type of companies are not relevant for Indian investors because they can more easily invest, in the domestic market. Logistic companies and mega caps, semiconductors, and cybersecurity have also done very well. And we find that these discussions we can have with clients are much more rich and easier if we talk about a theme. So I can really encourage you as an investor to think about themes that are attractive for the long term, and then find companies inside that. Our favorite themes right now that we overweight are logistics. So logistics, we think, will continue to deliver very strong shareholder returns because the world and global supply chains are becoming more complex, and thereby the largest logistics firms in the world can increase their pricing because they have pricing power because of the complexity, and that drives higher operating margins and higher returns for shareholders. India, we think, is an interesting country because we have the situation after the pandemic, but also because of the trade war between the US and China, that global supply chains, we think, will change dramatically over the next 5 years. More companies in Europe and the US will diversify some of their manufacturing out of China. So instead of relying heavily on China, they would diversify it into other countries like India, Vietnam, Cambodia, Indonesia, Malaysia, etc. Basically trying to mitigate some of the risk that are tied to having all manufacturing, or most of the manufacturing, in China. And then there is definitely a geopolitical trajectory where South Korea, Japan, the US, Australia are teaming up inside the Asian Pacific region, and India wants to compete with China as well. So we think that India will probably gravitate towards this security alliance over time. And if India plays its cards well, will opening up for foreign direct investments and make it more easy for foreign investors to invest in India. We think actually India over the next 10, 20 years will deliver returns that we saw Chinese equities deliver over the past 20 years. So very, very interesting setup. And I should say India has been the best performing equity market since 2000. We like the commodity sector. I think that goes almost without saying, because I just explained why we think commodity prices will continue to go higher. We think also the commodity sector is a good way to get exposure in an inflationary environment. We like cybersecurity because it's, I'll talk about it in a few minutes, but it's a very interesting growth industry. We like mega caps because in an inflationary environment, mega caps have global distribution and pricing power and higher return on invested capital. Basically, they have economics of scale. So think about companies like Unilever, Nestle, Apple, Amazon, etc. These mega caps we think will do well during inflation. Semiconductors, very interesting theme as well. It's a bet on cloud and data centers. It's a bet on electric vehicles. It's a bet basically on digitalization and Internet of Things. We really think it's an exciting high growth industry. Next gen medicine is probably the biggest I would say call option on the future, because we are moving into a new era. I'll talk about it in a few minutes in one of my slides. And then we like batteries. We like the battery industry as a different way of playing on electric vehicles. So you can play electric vehicles from the semiconductor side, because you need 4 to 5 times as many semiconductors in an EV compared to an ICE, an internal combustion engine car. And batteries is also a key component of electric vehicles. A lot of the pure manufacturers of electric vehicles are right now quite elevated in terms of market valuation. And then a final point, always stay invested. Don't try to time the market. This little table here shows you that if you lost at best 10 days in each decade in the US since 1930, you would hardly have gained anything in terms of return. So I've done this professionally for 11 years. I can't even time the market. The only thing I can say is that stay invested. Think about whether your portfolio is having the right balance constantly, or something in your portfolio is getting too highly valued versus the realistic expectations you can expect. And when you look at the global equity market since early 1970, but I could have gone 100 years back, if you stay invested in equities for the long term, you will earn the equity risk premium. And it's almost difficult to time the market, because as soon as you time the market and sell some of your equities because you're afraid of a recession or a drawdown in the equity market, as soon as you get out of the equity market, the next pain is, when to get back into the equity market. So timing the market is very, very difficult. Talking about India, we have our Indian basket, as I said, which are these GDRs. It's not relevant for you, but this is just to show you what since 2000, the Indian equity market in total return and in dollar terms have been doing extremely well. And I think it has been quite a big surprise to many that the pandemic and with the very terrible COVID waves in India, that you would have seen an equity market that was just blistering and moving to a new all-time highs. But it just tells you that the market is getting extremely confident in the long-term prospects of Indian companies, and the IPO pipeline is also getting increasingly interesting with a lot of new technology companies coming to the market. And we published our Indian basket back in March of this year. That was a very good timing. It has been an extraordinary, lucky and good call that we have had with our clients. If you look at the Indian equity market, it's priced at, if you look at a 12-month forward basis, it's a little bit more expensive than the US equity market, but not much. And I think if you look 10 years ahead, I think India has a pretty good probability that they will deliver higher returns than the US equity market. But you're an investor, you sit in India. I think if you are an investor in India, I still think, even though you have a good equity market, I think it's really worth investing globally as well in US companies. So what you get if you invest in US companies or US equities is that you can find extraordinary technology companies with exposure. A lot of Indian technology companies are not very big on the international stage, but you can find US and companies that are very big and very, very, very high quality. In Europe, you can find companies with exposure to green technology. Some of these newer, greener energy companies within hydrogen, etc. So I can really encourage you to look outside your domestic equity market for inspiration. A lot of investors, also our clients, are talking about electric vehicles. Peter, what is going on? I mean, what should I make of these high valuations? Should I invest in electric vehicles? Our main investment thesis is that you should invest in lithium miners, copper miners, battery producers, and some of the semiconductor companies that are delivering semiconductors to the car industry. That's probably the best way to play the electric vehicle, because right now there's a huge expectation built in these electric vehicle stocks. You have Rivian that have just done an IPO in the US, and right now they are valued more than Volkswagen, and they have booked zero revenue. So there's a lot of enthusiasm. I would also say that so far there's only two companies in the world that have really showed how to scale electric vehicle production in a meaningful way, and that's Tesla and Volkswagen. There are some of the Chinese producers, BYD, but BYD is also doing electric vehicles, but they also have done a lot of hybrids, hybrid plug-in companies, cars. So from the pure players side, I think Tesla is still, and that's one of the reasons why I think Tesla is so highly valued, is because it's one of the only pure plays on electric vehicles in size. But I think when you look at it, you could probably argue that the expectations are maybe too high. But on the other hand, if you look at the forecast in that chart from Bloomberg, you can see here that the electric vehicle and the percentage of annual global sales, passenger vehicles, is expected to be bigger than ICEs in around 2036, and you can see the growth trajectory there is pretty elevated. We like the commodity sector, as I said. We think it's a great bet on the super cycle and a good way to get some inflation protection. I've put in here our basket. You can find all our baskets, by the way, in our trading platform. I don't know whether you have access to it, but you can also find it on our homepage. Otherwise, I'm sure maybe Yes Securities can help you by finding some of these names that we've put in the basket. But this is the 40 companies that we have put in our commodity baskets, everything from agricultural, chemical companies, energy and metals and mining. And then the next gen medicine basket, I think, is an interesting one, because the 20th century, so the 19th century was about machines. It was the machine age. the proliferation of steam engines and growth in electrical motor designs, etc. Sorry, that came a little bit later. But then when we moved into the 20th century, in the early part, we got electrification. So that was a little bit of an overlap with the 19th century. Those are holding together. But then as we progressed through the 20th century, it became very much a century about computers, the transistors, etc. It has revolutionized our world. Many agree that the 21st century will be all about biology. It's the age of biology. It's the age of individual medicine. So we are still today, that's also what we see with the COVID-19 vaccines. We use this broad-based approach with vaccines and drugs that are hitting the general population with some average side effects. But we think in the future, we will see an explosion in our ability to do genome sequencing. And from that, being able to do much more tailor-made drugs and vaccines for the future. So I mean, some of these companies you can see here in the table, our basket is representing roughly a little bit more than $400 billion in market cap. I still think that the upside for this theme and these companies is extraordinary. And this is a multi-decade trend. I think if you invest for the long term and for your retirement, this is definitely one of those themes that you should have in your portfolio. I think I'm an optimistic guy, and I think it actually you're rewarded in this world despite all the troubles and the infights we have between different countries and wars, and we have had pandemics. Despite of all these things over the past 100 years, our rising living standards, not only in the Western world but also in emerging markets, have been extraordinary, and I think it will continue. And I think the potential in these newer technologies within biotechnology is just extraordinary. Cybersecurity, we have to talk about it. It's one of my favorite industries. It's a growth industry. It has what I call defensive characteristics. So today, you cannot operate a company without Microsoft's operating system or cloud infrastructure. So these are business investment necessities to operate a business today in a digital world. Cybersecurity has moved from being a small niche industry to being the attention of many boardrooms around the world. So we all have read these articles over the past 5 years with an increasing amount of attacks on companies and governments. And if you have a cybersecurity attack on a company, we had a company here in Denmark, which was on a home improvement retailer. They were exposed to a cybersecurity attack, and the company couldn't receive any online orders for 6 months. And as the CEO said, this was much worse than the actually having to live through the pandemic with lockdowns. And I give you a little bit of an idea of the tail risk and the severity for any business that are exposed to cybersecurity attacks. So, and if you look through the recent earnings releases from a lot of these companies, it seems to be that a lot of these companies are shifting gear in terms of revenue growth. And I think that's partly one of the reasons why cybersecurity stocks have been such a good investment over the past 2 years. Sorry, it's because investors are constantly upgrading their expected long-term growth rates, revenue growth rates for these companies. And as you can see here, the green line, it has done extraordinarily well against the global equity market over the past 2 years. Okay, so to sum up some of my thoughts here is that equities look expensive. You'll read many stories that equities are in a bubble. I don't think equities are in a bubble. I think the equity risk premium is still very much in line with what I consider being the comfort zone. If we get high interest rates because of high inflations, you will see equities be repriced, and some industries will do better in that environment and others will take a bigger hit. Some of the technologies and growth pockets of the market will probably see a higher repricing. That's why I'm telling you that although I also love technology, I think 2022 is the time to get a good balance between these interesting technologies and growth companies and a little bit more the value stocks. So you can look at energy companies, commodities in general, as I said, the mega caps. The energy crisis will probably not go away because of the underinvestments. and as the world is moving towards green energy, we think there could be elevated prices on oil and gas going forward. So if you don't care about ESG, and some investors don't care about it, I think there are some good opportunities short term in the energy sector and in the traditional oil and gas industry. We think inflation will bite. We think the inflation rate will be higher in many countries next year than a lot of central banks are expecting. And because of that, they will try to get ahead of the curve and hike interest rates. And hopefully they don't go into panic mode, because if they go into panic mode, then we probably could see a short-term correction to equities. But we always have these correction in equities, and for the long term, it doesn't really matter that much. As I said, stay invested. Investors should get exposure to the industries such as I said, commodity sector, mega caps, logistics, semiconductors, technologies. There is this growing risk in China, as I said, also that we get an interest rate shock, inflation, but we cannot time the market. So the best thing we can do is just change our portfolios as we go along and as the world changes. So if we have had the conversation 2 years ago, I would probably have recommended a higher exposure to China than I do today, because I think that the current policy trajectory of China probably will reduce the long-term returns for China compared to just 2 years ago. We prefer batteries and miners to play on electric vehicles, and then we think that the cybersecurity industry is a must-own and very unique industry. My team, I'm part of the SAXO Strats team. We can be found on Twitter. I've put in my handle there, so you can find me on Twitter there. We have on home.saxo/insights, you can read the latest analysis. We do a daily podcast in English, where we go through all the different markets. It's a 15 minutes podcast. We write a quick take every morning, which will be your sort of midday in India, where we go through the most important things. I've also put in a link there so you can find the podcast. But if you go on your phone, Android, iPhone phone, whatever you have, just go to your favorite podcast app and type in SAXO Market Call, and you'll find the podcast, and you can subscribe and give it a try. I hope you'll do. I think that was, and then inside the platform, this is just that slide we always do so people can find it, but this is the way to find the different equity baskets that we do, and that's a lovely disclaimer. That was my presentation. I was a little bit ahead of time, so that's always a good thing. So we don't talk too much. I've been speaking for 35 minutes, so I think I'm ready to take some questions, and I know I hope you have some good questions.
Thanks, Peter, for such a detailed insight presentation. We are sure those elaborated views on how the markets are going to shape going forward and the different themes which can benefit investors is definitely going to be a good word of advice for people looking to build a global portfolio. We'll take a pause of 2 minutes. We have already received few questions. We'll allow our participants a window of 2 more minutes wherein they can send across their questions that they would want Peter to address. So yeah, we'll wait for 2 minutes for a few more questions. Yeah. So while we wait for more questions to come, we already have a few questions that we can probably begin with. Peter, the first question is from Mr. Himanshu Sangvi. He asks, how do you see green energy and electric vehicles listed stocks on global markets to perform in near, mid, and long-term future?
I think that the long-term outlook for green energy and electric vehicles will be quite positive. So there will be extraordinary amount of opportunities, also risk for some companies. The problem with green energy stocks and electric vehicles is that the we've gone through a growth cycle and an rise in technology over the past 10 years that have educated investors to not be afraid of putting a high valuation on a growth and a new technology because they have been rewarded. But the problem, as I see it, is that today, when we look at electric vehicles and green energy stocks, the valuations are quite high. And to justify these high valuations, it basically reflects a very, very, very steep ramp up in revenue and operating margins to justify these valuations. And we actually earlier this year said that there would be some fatigue in the green energy, the green transformation trade, and that has been right so far. We think actually that next year there will be, a readjustment inside the car industry, and that some of the electric vehicle stocks will begin to underperform next year. But long term, we think that there will be a handful of winners in electric vehicles, and that will deliver returns. But I would say that in terms of the green energy, I think what we will see over the next year to 5 years is that we will see this race where you will have high quality and what we call green junk companies. They will begin to separate in terms of performance and what they deliver in returns to shareholders. So I really can encourage investors to not get too overly optimistic. And if you want to invest in the green energy, try to find a good balance of some of the companies that are more mature and already profitable. And then, of course, if you want to have exposure to hydrogen stocks, you can't find anyone that is profitable. So here you have to take a little bit of leap of faith that they will become profitable and justify the valuation that you're paying. I think you're on mute. I can't hear you.
Yeah, sorry for that. So the next question we have is from Mr. Mayur Joshi, and he would want you to address if the US tapering will have a negative impact on the precious metals and the Indian stocks per se.
If sorry, can you repeat again? What will have a negative impact?
US tapering of.
I don't. The tapering probably won't have an impact. I mean, the long term driver of commodity markets, and probably one of the it's one of those drivers that we rarely talk about in financial markets, and I don't see a lot of strategists talking about it. But the biggest key underlying dynamic in our society, global society, over the past 100 years, have been urbanization, because urbanization is what's driving demand for energy and commodities, infrastructure investments, and everything. So as long as I mean, China is right now just around a little bit above 60% urbanization rate. And in the developed world, we are closer to 85%. So China will still have to move somewhere around 200 and 300 million people into cities over the coming decades. And India will probably move 800 million people to large metropolitan areas over the coming decades. There will be a huge transition, and it's the same in Africa and in South America and some of the other Asian countries. So I think tapering and where the dollar goes is a short-term blip on the radar for commodities. But urbanization and the green transformation. The green transformation is basically will require a lot of copper, a lot of iron ore for steel production, because for all our projects and urbanization. And the green transformation is lithium, it's copper, and it's nickel, cobalt to some extent. So I see it as a short-term headwind with the tapering. I don't think it has a material impact on the commodity market.
The next question we have is basically been posed by multiple users, attendees today. They want to know, do the FANG stocks still hold enough steam if they want to consider them investing from 2 to 3 years of time horizon? Will it be, does the theme still hold good?
I am, so the FANG stocks are part of our mega cap theme. So the FANG companies have an extraordinary pricing power and global distribution and still underlying good growth. I mean, take a company like Microsoft. I mean, despite the extraordinary amount of sales they're doing, they are still able to grow between 15 and 20% in a year. It's just phenomenal. And Apple have also done pretty well. I would say of all the FANG stocks, the investment thesis is still intact. The growth rates are coming down a little bit, but that's also because they're becoming so big. But they're not outrageously overvalued, in my opinion. I still think it's quite safe. I would say the only company inside the FANG segment where the risk profile have gone up significantly is Facebook. So Facebook is still has an extraordinary social media portfolio of assets and still have probably the best advertising platform in the world for companies. But they losing out to young people. So young people are spending 3 to 4 times more time on TikTok and Snapchat and other social media sites. So they're losing out, and there is a key risk that the old Facebook platform is actually losing a lot of steam, and that will impact future profitability. And they have changed their name to Meta, and they're going all in on the metaverse, which is some kind of an augmented universe, which they believe is the future of computing. I understand why they're doing it, but it comes with a very high risk because one, they are first mover. Two, they are investing a lot of money into this, and their vision might be wrong. And if they're wrong, they will spend a lot of money on the metaverse. So yeah, that's probably the only company where I think the risks are going up inside the FANG segment.
Peter. The next question is from Amruta. She basically wants to know which economies will be leading the race amongst the peer going forward. Uh, so, how can they consider, if they have to look from building a global portfolio perspective, which economies can be considered a good investment destination?
Yeah. So if we look at the economic landscape, this is probably you're not surprised to hear this, but the emerging market economies will deliver the most growth and the biggest opportunities. Um, so you sit in India, you can invest in the domestic Indian equity market. If you invest through the SAXO trading systems, you can also invest directly in Chinese mainland shares, etc. There's also very good ETFs, but we would expect the emerging markets to deliver very strong returns over the long term. But then also you have a lot of the largest companies in the developed world also have a lot of exposure in the emerging markets, and they do sales and they do expand into the emerging markets. So there is no definitive answer to that question, but the growth will definitely come from the emerging markets, as I said. But and you can tap into that growth either by buying some of the large companies in the US and Europe with exposure in emerging markets, or you can buy some of the names directly. I don't think there's a right answer to it, but if you look over the past 17 years, the returns have actually been bigger in the emerging markets. But there have been some years since the great financial crisis where returns haven't been as strong in the emerging markets, and that's because of the strong dollar and some of the policy uncertainties, and then also because a lot of investors have been flowing into US technology stocks because they have consistently been performing so well. But if you are right about the inflation and the commodity super cycle, then emerging markets on a relative basis should also do quite well over the next 5 years, because typically that's what we see when we have rising commodity prices and a little bit of inflation. And also, if we get a little bit of a weaker dollar, then typically that favors emerging markets.
Our next participant, Mr. Dheeraj Gupta, would want to know a little bit about Saxo. What are the key offerings or the value proposition, and what are the charges if they have to subscribe to the offerings of Saxo Bank? So probably if you can elaborate a bit on that part to familiarize the offerings of SAXO Group.
Yeah, so I think so. Saxo makes it possible to invest globally across all the different asset classes. Bonds, equities, currencies, commodities. We have mutual funds, ETFs, um, and you can do that from a single account. I think we cover 40 different markets, almost all equity markets. We are one of the few that provides access to the mainland shares of China through the Stock Connect. We also have local Chinese bonds, if that's of interest to anyone, through the Bond Connect. But I think so. That's the value proposition. I think we are quite competitive on pricing, and you get this single service, all access to all these markets. We also have different type of automated investment strategies, which we do in collaboration with BlackRock, which is the largest asset manager in the world, where you can invest in a low risk, medium risk, high risk ETF portfolio. You That can be done for you quite at I think a good price. So I think that's about it. And then hopefully, I think our strategy team is a little bit of a positive value proposition, because the good thing about Saxo compared to large banks is that we don't have any corporate finance relationships with big companies. So I can be brutally honest, and our whole team can be quite honest on what's going on in the world in our analysis, and because we don't have to think about, there's no conflict of interest. So I think I hope also is a little bit of the unique Saxo way, that if you listen to our team, you get pretty unique perspectives on things that are not sugar coated.
Yeah. Our next participant, Mr. Shakti Sinha, would want to know that from the global perspective, the outlook that you have just shared, what would be a right route to invest if somebody has to look at global stocks, whether through an AMC stocks, a mutual fund, an SIP route, or directly into equities? Which would be a better option to approach this?
So the way I do my own personal investments is that as soon as you do single stocks and you create a portfolio, you have effectively said that you think you can beat the market. It's very difficult to do over the long term. Also, of course, lives have to be fun. It's fun to invest and to follow your companies. But the way I do it personally is that I have created. So I have 70% of my portfolio in broad-based ETFs, which is a mix of equities and bonds, etc. So that's effectively what you can get through these BlackRock portfolios we have. But otherwise, if you just want to do it simple, you could invest in a global ETF on the All Country World Index, which is both developed equities and emerging market equities. You can get those very low cost, so you could invest in that, and you can invest in a global bond portfolio and blend those two things. Then you get more or less the market return in a very simplistic way at low cost. And then personally, so I have 70% in a balanced portfolio with the low cost ETFs, and then the remaining 30% in my portfolio is in different single stocks that are exposed to some of these themes that I've talked about today. I think that's a very good way of doing it, because if you have 100% equity portfolio with single stocks, you have basically made a bet where you think you're confident and that you can do better than the market long term, and it is difficult. And sometimes you get it wrong, and sometimes equities will go through a period with lower returns, and then it's good to have a broad exposure, because you are invested in the wrong themes on your single stock portfolio, or you didn't get the bond return. So if you combine these two things, that you have a market portfolio that is balanced with ETFs, and then you have this little bit more risky single stocks portfolio, then I think you're combining the two really good concepts that will serve you well as a long-term investor.
For the response. Respecting the timeline that we had set for today's webinar, we will be limiting ourselves to two more questions, while we have been receiving far more. So the next question is, what's your outlook on just a second, why the US bond yield is not moving even after the inflation? Is the question from Mr. Gaurav Taneja.
It's a it's a very good question. I'm not a bond and a fixed income strategist. To be honest, I don't know who is buying bonds in their right mind with these with the current inflation outlook and these low yields. I think to a large extent, a lot of bond investors are still buying the transitory narrative that inflation rates will come down. Um, but that's why I think that if the if the if the narrative changes over the next 3 to 6 months, that inflation is actually will run at a higher level than what the central banks around the world are expecting, then you could suddenly see this massive repricing on the long end of the yield curve. We've seen that before, but we also think that as soon as the Fed signals that they go in tightening mode, you'll begin to see the yield curves are lifting, and yields will go higher. So, but right now, to be honest, I can't give you a good explanation why yields are not coming up faster. I think it's it's very strange why they are this low.
So the last question for today's session comes from Disa. Disa wants to know your view on Indian micro cap and small cap versus those of the other emerging market, especially considering that the balance sheet of Indian companies are at their best in decades.
Yeah, so I obviously don't know a lot of things about small cap companies in India, but what I can say is that history shows that small cap companies have a tendency to produce higher returns than large cap companies. We have been in a little bit of an extraordinary period over the past 15 years where large cap companies have done very, very well versus small caps, but they, if you go far back, then that has not been the case. The good thing about small cap companies is that if you can find the right ones that are not too overly valued, have a good balance sheet, and has an interesting product and service they sell, then you will obviously be able to get a much higher return on these small cap companies as they mature compared to just buying a big company. So I think small cap companies definitely are worth having in the portfolio. If you don't know which small cap companies to buy, you can always find an ETF or mutual fund on not only Indian but also emerging market small cap funds. I think there's definitely some opportunities there. I personally, in my own personal portfolio, I have small caps in my portfolio. It's not a big part, but it is part of the mix.
Uh, Thanks, Peter, for showing the patience addressing all the questions.
Thank
So, with
you.
this, we now come to the end of the webinar. We would like to thank Mr. Peter Garnry for joining us today and sharing his views on the market overviews and themes that investors can look forward to. We are confident this session would help all our participants to explore investment opportunities beyond India with a lot of confidence to help build a truly global portfolio. Thanks everyone for the participation. You can follow us on our social media handles to stay tuned on all upcoming events that we will be hosting going forward. Thank you all. Have a good day.
Thank
Thanks.
you.
Thanks, Peter.
Thank you.
Yeah.